Let's get started. All right, let's see. Oh, she doesn't want to move forward. Oh, what in the heck? All right, we'll try it like that. So, first and foremost, we keep talking quite a bit about the audit risk model and the inherent risk assessment. Some people will tell you don't be fearful of risks, understand them and manage and minimize them to an acceptable level. And that's what we do very much so in um in audits. So you're hopefully by the end of today, you'll know what audit risk is and describe it, how it's broken down into different areas. And obviously we have inherent risk, control risk, and detection risk. And so you want to make sure that you know each of those because you will see that on your exam quite a bit. And so you also want to explain the responsibility of fraud risk assessment when we're looking at an audit. So there are several types of fraud and there's several types of errors that might occur in an organization. As an auditor, we have to test for them. We have to make sure that we document that in our work papers. Additionally, we have the auditor's responsibility that we have to look at inherent risk. And that includes any type of risk assessment procedures that we should perform in the audit engagement. We have to also understand the different sources of information, and we have to do it by different means, right? So we have to either do analytical procedures, brainstorming, or inquiries. We have to explain how auditors complete and document the overall risk, which is usually by way of materiality. We also need to make sure that we take those special considerations of fraud into our audit work papers. And then we usually do an audit strategy memorandum. So that's how we go from there. So audit risk, make sure you have this in your notes. It's quite important. So it's the risk that the auditor will express an inappropriate, key point, inappropriate opinion when the financial statements are really truly materially misstated. So we would issue a clean opinion or an unqualified, right? So a clean opinion is unqualified opinion when actually the financial statements are actually materially misstated. So we usually break down audit risk into inherent risk, control risk, and detection risk. So you'll see the audit risk equals inherent risk times control risk times detection risk. Okay. And so inherent risk is that will even a material misstatement, will it even occur? Control risk is that you have the internal controls over financial reporting, right? And that's one of the opinions that we give, the internal controls over financial reporting. Those guys will not prevent or detect an error or a material misstatement. And then detection risk is that our procedures as an auditor will not detect it. So make sure you know the three components of the audit risk and make sure that you're able to decipher each of those. So here's just, I love visualizations. Who doesn't, right? So here is our audit risk, right? So we have inherent risk, control risk, and detection risk, and that gives us the overall audit risk. So the audit risk is that we will have an error that will occur, or we could have a fraud, and then our audit procedures don't catch it. So again, inherent risk, it's like the material misstatement, can it really occur? Control risk, our internal controls over financial reporting won't catch it. And detection, our own substantive testing won't catch it either. So we'll go from that. So make sure you have each of these definitions in your study guide. I think it'll help you greatly for your exam. So inherent risk is the probability that the absence of internal controls, material errors, or fraud could occur. So what typically impacts our inherent risk is the nature of the client's business. So do they have a competitive advantage? Maybe are they in a complex industry? And that also lends itself to what are the major types of transactions that your client is doing? Could that be transactions that maybe we don't have valuations for or difficult to value? So we would then have a valuation issue on the management assertions, right? Then we also have the effectiveness and the integrity of managers and their accountants. All right, so we look at managers and accountants. So we look at probably the top people, and then we also look at the accountants because those are the ones that are preparing the financial statements, and we as external auditors rely on their work, right? They give us the lead schedules. We ask for all that PBC provided by client. So control risk here is the likelihood that the client's internal control policies and procedures do not prevent or detect a material misstatement. So here we might have the control environment, and we're going to talk about when we look at controls, we look at COSO. So the Committee of Sponsoring Organizations, that provides the framework for us as auditors for our testing of internal controls. And we'll talk a little bit about this as we progress, but probably in another chapter. But that control environment is one of the 5 key components of COSO. And if you go to COSO.org, you'll see it all there. And it's called like a COSO cube. And it's another great visualization that helps us to understand the internal controls over financial reporting. So another factor that could impact our control risk is if there is a good, effective internal controls, right? They need to exist, and they also need to be effective, hopefully, that it would prevent, or bring down our control risk. And then nothing is really, if you monitor something, it's usually good, right? So if the client has monitoring activities, such as like an audit committee, now keep in mind, the audit committee, you have a board of directors, and that is broken up into 2 components, the audit committee and the compensation committee. So you have an audit committee and a compensation committee that is part of the board of directors, and the audit committee is considered a monitoring activity of the client. And so hopefully, and you as an auditor, if you find anything, you usually go to the audit committee. I mean, first you tell the client, but if it's material, and then you have to follow what the AICPA tells us in terms of how to go to the next level if we find some fraud or some material misstatements. So we go on to detection risk. That's the likelihood that the auditors, the procedures, are substantive procedures, whether they're analytical procedures, substantive testing of account balances, or substantive testing of account transactions, that those procedures will not detect a material misstatement in whatever we're using, either the account balance or the transaction. So what helps us mitigate detection risk, the number 1, is right here, nature, timing, and extent of your audit procedures. So the higher the detection risk, right, that we won't find it, then we have to do more testing. So our nature is going to expand. We might have to do it for a longer period of time, and we might have to extend our sample size if we're not doing continuous auditing. If we are doing sampling, then we have the issue of sampling risk. And so that's that you're choosing a sample, but that sample does not represent the population. So no sampling risk here is, so make sure you know the difference between these 2, sampling risk and no sampling risk. So no sampling risk is the risk that the auditor, we're going to draw a conclusion, but it's based upon the available evidence, maybe not all of the evidence. So sampling risk is that you are choosing a sample that is not representative of the population. No sampling risk is the risk that we as the auditors are going to make a wrong decision or a wrong conclusion because of the available evidence that we have. So note the differences between those 2. And then here you see the audit risk model all together. Inherent risk, control risk, and detection risk. And you see we set, as auditors, the audit risk model, but we assess the inherent and control risk based on us understanding the client. And then we calculate that detection risk. And so I would highly recommend keeping this chart in your notes because this will help you. You might see questions on your exam about, if you have lower detection risk, how would you handle the nature, the timing, and the extent? If you have higher detection risk, then you would have less effective tests. You would have to probably test at interim and at year end, and the extent, you would have fewer tests. So keep this close. I think this will help you answer quite a few questions from your exam. And here is, so this will also help. So it just tells you if your inherent risk is low, medium, or high, or moderate or high, what then your detection, your control risk, where it's landing, then you have your detection risk. So basically, you say we have a moderate a moderate inherent risk, and then say we have a a low control risk, then we would be here under our detection risk would be high. So then, but if we have a high inherent risk and a high control risk, then our detection risk would be low. So hopefully, I just like pictures. Pictures make all these words come to life, hopefully, for you. And that can be confusing. Now, one of my favorite topics is fraud. I always say fraud is sexy. I am certified in financial forensics, so I have served as an expert witness in fraud examinations. So I love it. The difference between fraud and an error is intent. So fraud and errors, the difference is intent. So like if you intentionally steal, that's fraud. But if you make a mistake, recording an entry, maybe transposing the numbers, then that's an error. So fraud is that you know that you are making a material misrepresentation of fact. And the intent, that's the key. The intent is to hopefully entice or induce somebody to believe that that fraud is true so that they suffer a loss and then you usually get the gain. So again, right here is the key difference between misstatements caused by error or fraud is the intent. So fraud risk gives us a special case of a risk of material misstatement, but these are mostly related to situations where management intended to mislead either shareholders, the marketplace, customers, vendors, whoever, because they issued fraudulent financial statements. And here, when you look at fraud, we usually think of like cooking the books, or we think of overstating our revenue so that we have overstated earnings. So that is typically where we see fraud. Or they just plain embezzle, steal cash, all that fun stuff. So there are different categories of fraud risk. And these could be that you have we tend to look at management quite a bit, right? So we want to make sure that management, what the characteristics that they have, are they competent for the job? What kind of influence is the CEO really like pushing so that everybody is, yes, we have to meet these earnings expectations. We have to make sure that we're hitting all these numbers. Sometimes the industry itself could be pretty pressureful, right? For oil and gas, I know I bring that up a lot because they drill, right? It takes a lot of money to drill, but if, man, you get that oil, it might be good. But what did you do to get that oil? And another item that we look at is financial stability, right? So obviously, if a company is cash poor, that makes us as auditors think a little bit more about that, right? Because we want to make sure that they are, they do have the money to continue to operate. And if we think that they don't, then what we do is we issue a going concern opinion. And a going concern opinion is basically that we as the auditors do not think, so it's a going concern. And we, as the auditors, do not think that they're going to be in business for another year. That's a bad opinion. Nobody wants that. Sometimes we should actually issue those opinions, but we don't. So here you have several items that would be part of your fraud risk factors. So, right, for management characteristics, you might, they might just, management might be a small group of people and they're dominating the decisions, or we have like bonuses and stock options that those are the incentives, but then, they might be able to kind of kind of manipulate the books to do that. Industry conditions, if your profits for your client are lagging and the client needs to catch up, that could be another risk factor. If they don't have sufficient cash flows, like I said, that's another risk factor. So you want to read through these to make sure you know what category they're in. So 2 types of fraud, and this comes from Wells' fraud hierarchy. So Wells' fraud hierarchy has 2 types of fraud, and Wells is the person that founded the ACFE, which is the Association of Certified Fraud Examiners. So number 1, we have fraudulent financial reporting, and number 2, we have misappropriation of assets, and cash is the number 1 asset that is typically misappropriated. So fraudulent financial reporting is where we put a misstatement or we omit something in the actual financial statements, and the intent is to deceive. With a misappropriation of assets, we're pretty much stealing, and typically cash is stolen. Now, there are 2 types of fraud. Employee fraud. Employees are the number 1 whistleblowers. So most of the whistleblowers usually work for the company, so they're an employee, but employees are also the number 1 group of committing fraud because they can take the money or they can take the property. Embezzlement, which I mentioned earlier, is another type of fraud where you are taking, right? So you're embezzling money. You're taking some money that should be for the company and you're using it and keeping it in your care. Okay, which means you're taking it. Larceny is just you're stealing. That's a nice fancy word for stealing. And selfification is another name for employee fraud or embezzlement and larceny. So make sure you have these definitions in your study guide, especially being able to decipher. You might get a scenario on your test and it'll ask you what type of fraud is this. So that is the best way to study here. And here you see all of the groups and the types of fraud. Like I said, probably employees is the number 1. And you could have ghost employees, meaning that, like in payroll, a HR person might be paying themselves, or you can have issues where you're looking at employees and you see the same bank account. And unless it's some type of relationship, then that's probably one of the most types of fraud we have. Then when it comes to AP, vendors and suppliers, you have double billing or false invoices that maybe you only received 5 of a product, but the vendor is charging you 10. And then usually management ends up in here under fraudulent financial statements. So inherent risk, we said it's for the entire audit process, right? Inherent risk is basically your susceptibility of an assertion within the client's financial statements that a material misstatement is there, but that the internal controls don't help us in that regard. So you see how many times we've mentioned this. And then you see here misstatements by assertion. So when we're looking, for example, at completeness, do we really have everything? Do we have all of it? Or did we omit something? Or did we fail to do a disclosure? Same thing with cutoff. Did we put it in the right period? Usually that's in the wrong period. Did the client sell product in January but tried to record it in December? That's very common. So depending on, there's certain factors that are related to this inherent risk, right? Or the susceptibility that the accounts are misstated or the susceptibility that the accounts have fraud. Typically, we look at the dollar signs, right? The dollar signs, liquidity. Does the company have cash? How many transactions, right? If there's a ton of transactions, can we really audit it all? What's the complexity of the transactions? And are there estimates? We know that we have in accounts receivable, the allowance for doubtful accounts, that's an estimate, right? In property, plant, and equipment, we have depreciation, that's an estimate. If we have goodwill, then we know we need to do an impairment test. So these are all just right here in the asset account, how many estimates we have on the balance sheet. So things to consider when you're looking at overall inherent risk. So the auditing standards require us that we as external auditors need to understand the business of the client. Okay. And we need to do that so that we can actually perform the audit, right? So if you're understanding the business, you need to understand the industry, the regulations, maybe the company itself, the related parties is very big. That's one area that is a high risk when we're talking about auditors. What we do. And we also have to understand the computerized processing. So here we kind of do an IT audit. So we might get a specialist here to run an IT audit for us. You, as the auditor, need to know GAAP, right? You need to know the accounting principles and the disclosures because you are preparing an audit report, which includes the opinions and it includes your financial statements and your footnote disclosures. Maybe any related business risks. We do a lot of analysis, usually by way of analytical procedures here, to understand the company's performance and to understand how, we do a lot. We do the common size financials and we try to see how the company's measuring, and then we try to see year over year fluctuations to kind of see where we're going to do our nature, timing, and extent of our tests. So where do we get all this information from? Like, how are you not just supposed to know this, right? So we look at usually trade magazines and journals, we look at, newspapers, and then we look to the company as well, right? So there we look at the bylaws, any partnership agreements, any board of director minutes, any legal proceedings. We do, even though for legal, we also do legal confirmations. So a legal confirmation, we usually send that out towards the end of our field work because that's only valid, I believe, for 45 days. So that gives us, we send a confirmation to the attorney and the attorney tells us everything that they're working on with our client. And like I said, we do minutes of meetings, we do anything from the board. So we look at everything in order to see, to get to our audit planning and to get to our tests of our substantive tests. So when we do preliminary analytical procedures, we're looking at problem areas. And typically, a lot of the problem areas is revenue. That's probably the number one that we look at. We look at related party transactions. That's also another area. Any type of complex transactions, if we're looking at derivatives or any type of financial instruments that do not have an easy valuation, which is typically market. So we're looking here for a starting place to try to see, hey, this is the financials from last time. This is what we have now. Let's see where the fluctuations are. And then hopefully the client will help us understand what's going on, right? And so and here we try to get what the client is doing, because this is going to go under the MD&A, the management discussion and analysis, which is what the management provides as part of the annual report. But then we still have to look at it as auditors to make sure it's saying what we think it should be saying. So when we do analytical procedures, we develop an expectation. That's our first step, right? We hope, like I just said, we're looking at revenue. Maybe we know that this client has complex transactions or they have very complex loans. So that would be our expectations. Then we do our common size financials. So we might do ratio analysis. We'll do vertical and horizontal analysis. So then we'll start looking at the significant differences. Then we're going to compare what we have, like our expectation, to what was actually recorded on the financial statements. And then we start investigating any of these significant differences. And then we document everything throughout the process. So again, I should be able to pick up your audit work paper and know exactly what you did when you did your analytical procedures. So in order to we also have to do brainstorming as an auditor. So here we're trying to see, so it's a required procedure. So make sure you have that in your notes. Brainstorming is required. It's required by the auditing standards. And even though we might have previous experience with the client, we might be with the client for 10, 15 years, we still have to try to gain an understanding of what happened new within this audit period, see how maybe fraud can happen and how the company or the client or, the management could conceal that. And then what procedures does management have to hopefully detect fraud? And we set the proper tone for the engagement. So if we're feeling comfortable with the client and we think, okay, we've been working with them, we looked at their internal controls, we don't think that there's a high propensity for fraud, then we're okay. And then we can probably do the audit. If there is a high propensity for fraud, if we do not trust in the integrity of management, then we should not accept the engagement. And then we do inquiries, right? So we talk to management, we might talk to their internal auditors, we might talk to the board of directors, which we know the audit committee is part of. We might talk to certain select employees, maybe the accounts receivable manager, accounts payable manager. Obviously, we're constantly talking to the CFO, but maybe the controller. If there's plant controllers, we would look at them as well. So once we have everything documented and we have assessed inherent risk, then what we need to do is we need to see what risk needs to be for each of the financial statement accounts and disclosure. So we evaluate both quantitative and qualitative risk factors when we're looking at the financial statements. And so don't make that mistake, right? We are looking at always the numbers, that's the quantitative part, but we also have to look at qualitative, like that tone at the top, or the propensity for fraud, or if we do follow your gut on this one, if you see that, if you see something suspicious, look into it, let's see what's happening. So we have a significant account and disclosures. Once we figure out what we need to do, then we go look at the relevant financial statement assertions. And a financial statement assertion, it has to be reasonably possible of containing a misstatement, which would cause a material misstatement in our financials. So a financial statement assertion is relevant if we think as auditors that it is reasonably possible that it could contain a misstatement, and that misstatement would cause our financial statements to be materially, that's the key word here, materially misstatement. Because remember, an unqualified opinion, you are free of material misstatement. So here we go through what can go wrong for each of the accounts, like cash and accounts receivable. And then that's what you're thinking when you're looking through an audit. And then we have to document everything. Like I said, your work papers should stand for itself. So you'll have discussions with, our team, part of the engagement. We're going to look at, identify, and look for risk. We're going to make significant decisions throughout the audit. We're going to look at these specific risk areas and then provide our responses. We're going to explain why improper revenue recognition is not a risk. That's always something that we look at, like I said. And then everything, we're just going to make sure that everything is, if there's a management override, we've looked into it, any other conditions that we think we need to do or look at, and what additional procedures. And all of this is usually communicated to the audit committee. And so we talked about fraud. And so when we have that, we got to make sure we're always examining journal entries. We're always examining adjusting journal entries. We're looking at the estimates, like I've said, and we're looking at the rationale, like why did this happen if it's an unusual transaction? If the company is closed, why are we doing entries at 2 o'clock in the morning on a Sunday? What's going on there? So things just like more common sense things. If there is fraud risks, then you do have to follow up on it. So if there is evidence that fraud has existed, you have to go one level above where you think the fraud occurred. And if it is with management, then we usually go to the audit committee. So remember, one level above and audit committee. And any fraud you have to tell the audit committee about, and you got to get them involved. So then we have different compliance levels for our laws. So we have direct effect compliance and non-direct effect. So make sure you know the differences between those. And what are some of the indicators, right? If we don't have an audit trail, if transactions are recorded when they shouldn't be, then where we are at. And then we end with our audit strategy memo. And basically, this is where we say in our work papers that this is the nature, timing, and extent of the audit procedures we're going to do, what the objectives of our audit engagement is, what those significant factors are that we're going to look into, and any preliminary assessment that we've done. And so that gives us everything that you need to know. Awesome.